Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Checkup, one portfolio manager will reveal why it's a good idea to, quote, hide in great balance sheets during uncertain times. We'll explain exactly what that means. Plus, cloud company CoreWeave is making its debut on the NASDAQ today. We'll discuss the IPO and the company's future live from the NASDAQ with the co-founder, Brandon McBee. Plus, all this week, Wealth will discuss spring cleaning your finances. We are digging into some different areas of your financial life, your budget, your investments, and your debt strategies in order to get you on a good financial path for the rest of the year. It's getting personal, but it's a good thing. First, let's take a look at some of the market action 90 minutes into the trading day. Stocks right now are under pressure as you're seeing the Dow lower by 1.4%. The S&P 500, that's down 1.6%. And the NASDAQ, that's slipping, falling right now by 2.2%. So this, as the Fed's preferred inflation gauge, comes in a little hotter than expected. Joining me now, we've got George Cipollini, who is the Penn Mutual Asset Management Portfolio Manager. You say it's a good idea during uncertain times to hide in great balance sheets. So explain how investors can do that right now.
Brad, great to see you, and thanks for singing a little bit for us today. Certainly in times of uncertainty, the easiest place for us to hide as individual stock and bond pickers is great balance sheets. And why is that? If you have a company that has more cash than debt, you're not subject to the capital markets. You can operate your business, and you really don't have to worry about whether or not you have to pay off a certain bond that's coming due. So I think that's always been a great place to hide. Now, you probably won't get that on more of a passive investment level. You might have to shift over to more active management, which I'm always a big proponent of. But again, because active managers can kind of see through good balance sheets, they can see through to good fundamentals. And I think at this point, fundamentals is critically important in a market where we've seen technicals and momentum kind of just fall apart.
You know, in one of the notes this morning from Apollo chief economist Torsten Slok, he'd mentioned that tariffs have a negative effect and impact on corporate earnings as companies experience higher production costs. And so that factors into the balance sheet consideration for certain here. So what should investors be looking for as companies are not just making those announcements, but as they're looking through and combing through earnings reports, including those balance sheets, to really get a sense of how companies are adjusting for the impact of and the anticipated impact of any type of tariffs?
Thornton is absolutely right, because again, with all the tariff talk each day, each headline feels different. Each headline is creating more angst in the markets. And so you really have to know what you're investing in and what that company plans on doing. Because the company management, they're uncertain as well. So we spoke with over 10 companies last week, 10 CEOs last week, and we tried to get a flavor of, okay, how do you adjust for this headline, or how do you adjust for that? And so I think the key takeaway is that the really, really good companies and well-managed companies, they see over multiple decades, and their businesses are super stable. So they're not going to adjust to every headline. And so again, if you look at companies' long-term margin structure and long-term return on capital over a very long period of time, they're going to be able to navigate through almost any environment. And those better companies, to us, are of value in this kind of market.
With that in mind, what do you think the theme that will play out as we're kind of previewing the next earnings season here? What do you think the core theme is to watch as we get into some of those earnings calls and hear from executives and management?
So Brad, this is an excellent point to talk about, because the initial reaction, the gut reaction, is a rotation, right? We had a rotation from growth into value, a rotation from consumer discretionary into consumer staples. And with all these rotations, you just assume that the staples companies will do well, but food companies are under their own pressures today. And we're starting to see that as well. And we heard that from General Mills, for example, in their report that was just a week ago. So again, I think we need to go back to companies. So there's a company today that reported, I can't name the name, but they make natural gas facilities in the U.S., natural gas power plants. They did great. Their backlog increased by close to 80%. And so those are the companies we want to focus on. But again, that's not broad exposure. You really need to read into the details of each company, find the good management teams, find the good balance sheets, and those companies, hopefully through the next few quarters, will be much more stable than the broad market.
With that in mind, what is your kind of top idea as we enter into this next quarter?
Yeah, so I mean, a lot of the names that we have in the fund have gotten cheaper, and we like them a lot. So from a stability standpoint, one of the things that we've liked to see over time are water utilities, for example. Those companies traditionally traded at huge premiums relative to the S&P, relative to other utilities. But over the last few years, that multiple has contracted a lot. And so those names, again, in this area of the market where things look so unstable, their results should be pretty stable. We do like that area. Again, individual companies that are increasing their backlogs and that have good balance sheets where they don't need funding moving forward, we like that area as well. Some investment grade and higher yield bonds, again, going back to the balance sheet with more cash than debt, they're going to have the wherewithal to survive this environment. And again, you're going to get nice yields, 5, 6 to 7% yields. Those are all areas that we like today.
George, great to see you. Thanks so much for taking the time with us today.
Always appreciate seeing you, Brad. Thank you.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we got to talk about Ferrari getting upgraded to overweight from equal weight at Barclays. The analyst says they previously downgraded the stock, but now they see a good entry point. Shares have fallen around 6% over the last month, and the firm also notes the luxury automaker confirmed its guidance despite President Trump's announcement of 25% tariffs on all cars not made in the U.S. Ferrari says prices will not change for cars imported before April 2nd, and they will not change for certain models no matter when they arrive. Other models may see a 10% price increase depending upon new import costs. Next up, staying in the automobile landscape, Tesla getting a price target cut at Deutsche Bank. The analyst reiterating his buy rating, but reduced his target to $345 a share from $420. That's upside of around 26% from Thursday's close. The firm still sees first quarter deliveries coming in below estimates, which would represent an 11% loss from the prior year. The analyst says that likely means auto margins will be under pressure, greater pressure there. Deutsche Bank writes that Tesla has been under pressure recently, driven by weaker auto volumes, broader derating in growth assets, and to some extent, political and policy uncertainty. The firm does not think that the EV maker will likely see minimal impact from current tariff guidelines. Well, NVIDIA-backed cloud services provider CoreWeave raised $1.5 billion in its U.S. IPO, selling 37.5 million shares at $40 apiece, a lower price point than initially planned. NVIDIA, an initial investor in the company, anchored the sale with a $250 million order. That's according to reports. Now, CoreWeave's debut is being viewed as a bellwether for the long-dormant IPO market. Joining us now from the NASDAQ, we've got Yahoo Finance's executive editor Brian Sazi and Brandon McBee, co-founder and chief development officer of CoreWeave, going public today. Brian, I'll toss it over to you.
All right, thanks so much, Brad. Brad, good to see you here. You can see people waiting. I guess the team over there waiting for the stock to open. Has it opened? Yeah, there we go. We were talking off camera. This has to be a wild day for you. You started as a commodities trader. I mean, take us through what this whole process, roadshow, this day has been like for you.
Well, a little bit different than being on a trade floor, and a little bit different than when I was building these computers when I was a kid, when I was 8 years old. So, roadshow process, testing the waters. It is a relentless process of meetings. Right. It is 12 meetings a day with maybe 15 minutes in between, and you're running out the door, jumping in a Suburban, getting to your next meeting, throwing your ID card on the table, and like getting up the elevator and doing the same thing again. It's been a fantastic process, and the investment banks who are running this, Goldman Sachs, JP Morgan, Morgan Stanley, they kept commenting that this has been the most overwhelming amount of investor interest that they've ever seen. And, it's made a lot of sense to us because this is a brand new business that no one has ever been able to see before in the public markets within the already high velocity space of AI. So it's been really exciting.
In doing my research for this company, Brad, I take us through a little bit about the model. Now, you've raised $14.5 billion in debt and equity across 12 financings.
Yep.
That's a lot of debt. How does that work? And then what if the economy slows down? What if we don't need all this AI? What happens to this debt on your books?
Yeah, so this has been my primary role, and we were the first to bring to market this concept of taking revenue, backing it with infrastructure, and then collateralizing all this together. It's a fancy way of saying that we match our client demand with our revenue profile and then establish these debt facilities to help support the growth of the business. So we work with the world's leading AI labs and enterprise adopters of AI, and they tell us what they need in the market, and then we go build it. And when we build it for them, they're asking us to deliver infrastructure for 3 years, 4 years, 5 years in these fixed term agreements for them that have like the same price of compute throughout that term, because they need to be able to access that compute for many, many years.
Gil Loria over at DA Davidson said you are buying depreciating assets in, I guess, NVIDIA chips. Should investors be concerned about that?
We use a 6-year depreciation schedule, which is industry standard. And the way you think about a depreciation schedule, that is useful life of the infrastructure, right? We actually see infrastructure on our platform being used for more than 6 years right now. I think we have some compute from like 2018, 2019, where clients are still saying, I need that for my LLM or my AI application, because at the end of the day, it's not just one GPU that rules everything or one model that's the best for everything. It's this matrix of different sizes of workloads versus different sizes of infrastructure. And our clients are just filling in that matrix volumetrically. You don't need a NBL72 GB200, which is this amazing cutting edge piece of infrastructure that powers some of our thought leaders in this space from within our client base, for running an 8 gig model from 5 years ago in the LLM space.
Has AI infrastructure already been overbuilt?
Not that we see. And this discussion of a AI bubble, we don't understand it.
I think it was Alibaba chairman this week, Joe Tsai, saying that.
This is a recurring theme, right? This isn't the first time we've talked about an AI bubble. And each time the market says, AI bubble, all of a sudden there's this massive product growth that comes, people get quiet for a little bit, and then they're like, well, we should start talking about this bubble thing again, and it starts popping back up into the market. But our position is clients come into us, and they are saying, CoreWeave, we recognize you're the best at delivering this infrastructure in the space. We need more, and we need a lot more. And that scale of growth is just continuing to accelerate for us. That's why we're going public, is to support our clients and their growth requirements for infrastructure that we bring to market for them.
About $1 billion, you're raising $1.5 billion here. About $1 billion of that will go to servicing your debt. How much of a burden is it that you have to pay out that type of interest on all the deals you have done?
Yeah. So use of proceeds on this transaction, right? First and foremost, it is to go grow the business. That's research, sales, development. It is just capital for the business to keep moving forward. Part of the proceeds is for some debt facilities. These are a part of many debt facilities that we run, but keeping in mind, all of these facilities are directly linked to contractual revenue for us. That is supporting our growth, and it's effectively underwritten by these multi-year commitments that clients make to us because they need this infrastructure for long durations of time.
Get a question from our anchor, Brad Smith. Brad, take it away. Get a question to Brandon.
Hey, Brandon, thanks so much for taking the time here with us. I just wonder, from the CoreWeave executive and leadership team, how you were looking across this era right now of volatility in the markets, and why now was the time for CoreWeave to go public, knowing that that's something that a lot of businesses are trying to evaluate, especially when they're making their market entry.
Market timing is incredibly difficult, but this was the right time for us to move forward. And our move into the public markets is dictated by our client demand. They need to be able to access more infrastructure and grow at the pace of AI software adoption.
Certainly. And then just as a follow-on to that, you talked about the total addressable market growing to $399 billion by 2028 here. The percentage of that market that you anticipate that CoreWeave will be able to generate some type of run rate around, what does that look like as you kind of look out into the future?
So when we look at that market, we interpret it as something that's growing at 40% year over year. And CoreWeave is a market share grower within that sector. Our product is servicing AI workloads. So that's training, inference, fine-tuning, everything that sits in there. We are the critical piece to connecting the artificial intelligence products that the world's thought leaders are bringing to market to the consumers of those products.
All right, we're taking a look at the offering price that was up there on the screen, $40 a share, but the indicative price, it sounds like, is somewhere closer to $46.50 a share in your debut today. We're going to be continuing to track that closely. Brian and Brandon, thanks so much for taking the time from the NASDAQ.
Thank you.
Coming up, a slew of tariffs are expected to kick in on April 2nd, President Trump's so-called Liberation Day. I talked to an expert about how these policies are impacting small business owners. That's next on Wealth. A wide range of tariffs are expected to go into effect next week, including tariffs on foreign-made cars, reciprocal tariffs, a resumption of the Canada and Mexico tariffs, as well as tariffs on countries importing Venezuelan oil. These policies have sparked fears about rising costs and potential economic slowdown. Only 29% of small business owners believe that the economy is in good health, according to the U.S. Chamber of Commerce. For more on this, we've got Tom Sullivan, U.S. Chamber of Commerce Vice President of Small Business Policy. Tom, good to have you here with us. So how are tariffs impacting small business sentiment from what we can see right now in the data?
Brad, in answer to your question, we ask our business members, and with 3 million businesses and a partnership with 1,600 state and local chambers of commerce, it's a little hard to call them up and ask. So we partner with MetLife, and we survey small businesses every quarter. Our most recent small business index, just released, shows that confidence is way down, and part of that is because of the fear that tariffs will raise prices. I mean, Brad, keep in mind that for 13 consecutive quarters, our MetLife and U.S. Chamber of Commerce index has said that inflation is the top concern for small business. So we saw optimism spike immediately after the election because small businesses believed that the new administration would bring costs down. Now, with tariff uncertainty, unfortunately, the reverse is true, and they are really scared that prices are going to go back up.
What are the actions that small businesses can take to best insulate themselves?
Well, right now, small businesses tell us at the Chamber that the best way to kickstart the economy is to open up new markets around the world for the best American-made products and services. And not many people know this, but Brad, there wasn't another free trade agreement partner that came on board in the last 5 years. There are 20 free trade agreements around the world, and the small business owners tell us that the way to boost the economy is open up new markets. So as much as small business owners take pride in their products, take pride in their services, we need a president that will open up new markets for them to sell.
And so it seems like, at least as of now, that the president is moving more on an agenda of less globalization, deglobalization, in fact. How are small businesses trying to figure out, okay, where are their best global opportunities, knowing that that's what the president now has campaigned on, that's what he's kicked off his term with, and now that's created more uncertainties and challenges for those small businesses to enter into new markets?
Well, small businesses tell me that they were very excited to elect a pro-business candidate to occupy the White House. And so right now, you're right, there's uncertainty that is causing price pressures on small businesses. And it's not just the sectors that are targeted through new tariffs. It's the fact that small business owners know their employees have to spend more at the grocery store, so they have to pay them more in salary. And so that type of squeeze that small business owners feel ends up tamping down their plans for growth. And at the U.S. Chamber of Commerce, we are all about growth. So anytime we see a small business index like we did recently that says plans for growth are stalled, we get concerned. Now, you asked, where is there the opportunity? Where's the opportunity for the president to really try to turn things around? We believe that that opportunity is making permanent the pro-growth provisions in the tax code. We have leaders in the House, the Senate, and President Trump all agreeing that these pro-growth provisions that help small business should be made permanent. That permanence is the antidote to uncertainty.
Tom, while we have you here, you mentioned a core part of this in that optimism also impacts some of their hiring plans too. What are you hearing from small businesses on that front, and where it could flow into the data prints on things such as the employment situation every month?
Well, Brad, I'm glad that you asked, because actually employment plans is one bright spot in our small business index. For the past 3 years, small business owners have been desperate to hire up to meet consumer demand. And so even though all of the index indicators declined, which is certainly cause for concern, their plans to add employees hasn't declined too much. And so we see about 20% of small business owners wanting to hire new employees this coming year. And in fact, our friends at Vistage, who do a similar survey with the Wall Street Journal, they're estimating that 48% of small businesses want to add employees this year. So that is the one bright spot within a series of declining survey answers.
Tom, some really key insights there. Thanks so much for taking the time with us.
Thank you for having me, Brad.
Coming up, if you're one of the millions of Americans who works from home, we've got some tips to help you get the most money back on your tax return and avoid any potentially costly mistakes. That's on the other side. Let's get a check of the markets here for you as we're seeing declines across the board for the major averages. The Dow Jones Industrial Average down by 1.25% right now. The NASDAQ Composite lower by 2%, and the S&P 500 down by 1.5%. This on the same day as a PCE print that came in just a smidge hotter than expected here, and that is, of course, the Fed's preferred inflation gauge. We're taking a look at declines across the major averages. Want to dig into some more of that activity here as we're taking a look at the sectors. And we've got almost all sectors in negative territory except for one, utilities. Utilities up by 1.2% here during the day, but the worst of the decliners coming in the form of consumer discretionary down 2.5%. You're seeing technology down 2%. You're also seeing communication services down 1.9%. Since I mentioned technology, let's check in on the NASDAQ 100. You've got actually all of the Mag 7 companies in negative territory right now, giving back some of the earlier gains, even for Tesla, which did start off the day in positive territory, as you could see there at the beginning moments, the formulation of today's trading session here, and then ultimately pulling back. Same for Amazon. That's actually worsened in its declines that we've seen here over the course of today. That's down by 3.3%. And then also rounding out some of those Mag 7 moves lower here, you've got Alphabet down 3.4%, Meta Platforms lower by 2.8%, and then Nvidia, Microsoft, and Apple all in the red right now. The Social Security Administration confirmed it is delaying changes to its enhanced identity proofing policies from March 31st to April 14th in order to, quote, ensure our employees have the training they need to help customers. On March 18th, the agency announced it will require applicants to prove their identity using the online My Social Security account or going to an in-person Social Security office rather than using the phone. In the updated guidelines, applicants for Medicare, disability, and supplemental security income will be exempt from the enhancement requirements, according to Acting Commissioner Lee Dudek. Quote, multiple opportunities exist during the decision process to verify a person's identity, end quote. Starting April 14th, applicants for retirement, survivors, or auxiliary spouse or child benefits will need to adhere to the new verification rules and either confirm their identity online or in person. The agency says exemptions apply in urgent situations such as terminal cases or prisoner pre-release scenarios. In 2024, over 35 million Americans worked remotely, representing nearly a quarter of all U.S. workers. And if you're one of them, your taxes might look a little different than those for in-office workers. Here to help make sure your returns are mistake-free, we've got Andrew Gordon, Gordon Law Partner and tax attorney and CPA. Andrew, good to see you. If you work in a different state than you live, how do you determine where you owe taxes?
Well, gosh, Brad, great question, and thank you for having me. Always a pleasure to be here and talk about taxes. And the tax code is already very complex. It takes basically an attorney and a CPA to understand it. But an area that's gotten even more complex since COVID are the state tax rules. And that's because a lot of people nowadays are working remotely. And what that means is that you might be working in one state and your employer may be in a completely different state. And in our income tax system, there are two levels of taxes. There are typically federal taxes, which impacts everyone, and then state taxes. And depending on your state, you may be paying state taxes as well. Now, the factors vary, and that's the problem, and that's what makes it even more complex. Not only might you be paying taxes where you reside, in fact, you typically will if your state collects taxes, but you may also be paying taxes where your employer is located as well. And that's because after COVID, more and more states have started to pass what's known as the convenience of employer rules. And so states like New York, Nebraska, if your employer is located there, even if you're working remotely, you may still pay taxes in that state. And so we see all the time clients that get caught by surprise because they have this additional state tax obligation. So it's something to be aware of right away.
Are there any ways to avoid being taxed by multiple states in that situation?
Yeah, Brad, I'm glad you asked. I'm not here just to rain on everyone's parade, but there are also ways that you can eliminate or reduce this tax bite as well. A lot of states have what's known as reciprocity agreements. So if you pay state taxes where you reside, it can also apply to the states of your employer. In addition, if there is no reciprocity agreement, most states allow you to take credits for taxes paid in other states. And this acts to basically eliminate the double taxation. What you end up doing in many situations is paying the tax of the higher state, but you often don't have to pay double tax overall. Now, you do have to file in both states. Another way to avoid this is to establish domicile or residency in a non-tax state. There's more and more states that are now becoming non-tax, no income tax. In fact, Mississippi just yesterday passed legislation repealing their income tax.
And so when it comes to deductions then, how do you figure out what you can qualify for if you are working from home?
So deductions also more and more complex nowadays. The Tax Cuts and Jobs Act, something you might have heard me talk about before, eliminated a lot of the deductions that impacted employees. And so, for example, you can't take a deduction as an employee for non-reimbursed expenses. You used to be able to. And so as the Tax Cuts and Jobs Act comes up for votes again in the coming year, it's something to pay attention to. So a way to act and still get this is through employer reimbursements. So have a conversation with your employer and see if maybe you can adopt a reimbursement plan so that certain expenses, home office use, other types of expenses could be deducted by your employer and non-taxable to you as well.
And so what if you are an employer with workers in multiple states? What do you need to do in that instance?
Yeah, so there's different things that you need to be aware of. It's not as simple as just having someone in those states. You typically need to register with the tax authority of each state where you have employees. Not only do you have to register, but you also have to withhold taxes. And this could be not only state taxes, but sometimes even local taxes as well. And then finally, a third prong to be aware of is unemployment taxes. Many states require that you pay unemployment insurance towards unemployment, even if you have one employee in that state.
Andrew, great to see you. Thanks so much. The clock is certainly ticking here towards that tax day. We appreciate it.
Thank you.
Coming up, it's that time of the day, folks. We're helping you spring clean your finances, and today we have a twofer. First, we give you tips for sprucing up your financial goals, and then we've got 3 ways that you can spring clean your home and avoid some costly repairs down the line as well. That's all next on Wealth. This week on Wealth, we're spring cleaning your finances, taking a look at ways that you can set up yourself with good financial habits for the rest of the year. Today's focus is sprucing up your financial goals. A U.S. News and World Report found 82% of Americans have a financial goal for 2025. And some of the most common ones are saving more money, paying off debt, buying a car or home, investing, and saving for retirement. Here to dive in, we've got Derek Hodges, who is the CFP and financial planner at Anchor Point Wealth Management. Great to have you here with us. So how can people do an audit essentially on their savings goals and figuring out if they're on track or not?
Yeah, Brad, thanks for having me. I think financial goals are so crucial. They're your milestone that you can kind of evaluate your progress. If I was traveling from New York to LA, I would pick a route, and there would be cities that I would expect to encounter along the way. And if I got off track, I would know it pretty quickly. Same way with your finances. If you have a goal that's written, measurable, has an amount, has a date certain, you then have something that you can start to evaluate your progress and then make course corrections along the way.
How do you adjust your financial plans based on changes that could pop in your life and some of those analogous cities that you were talking about hitting on the way to those goals?
Yeah, I think being flexible with your financial plan is crucial. So first of all, your financial plan serves you, not the other way around. And so your financial plan needs to be adjusted when there's life events. So if you have a baby along the way, that's a big change. You're going to have to evaluate some of your goals. You're going to have some other financial challenges that you'll have to consider. Marriages are certainly some of those events that will take some adjusting in your financial plan.
How do you develop habits that can keep your finances clean year-round to achieve your goals?
Habits, I think, are the key. And I think just consistency in all of your planning is what's going to give you greater advantages. So simple things like retirement planning. I think going into your 401k, if you have one of those, and setting up automatic increases in your contributions. Typically those work where every January 1% is increased to your contribution rate. Those have massive effect on your overall plan, and yet you're probably not going to miss that money. And so I think that's a great one right away. And I think having greater discipline and consistency with your debt is so important. Right now, we're in these high interest rate environments. We still have kind of tough inflation. So pocketbooks are really being strained right now. So credit card debt, is one example, is just a killer right now. So growing that discipline to pay as you go is so important. Stockpiling credit card debt is going to get in your way. It's going to hold you back from many of your other financial goals.
How much debt should you be keeping on those credit cards? Because a lot of us were taught just pay the thing off in full. Some of us were taught to keep a balance. What is kind of the good rule of thumb that you use?
Dang, Brad, it's Friday and I'm going to be the buzzkill here, but I'm going to say no balance. Listen, right now, credit cards, generally speaking, are going to be well north of 20% on interest. I can't find a way that that's going to be positive for anybody's pocketbook. So I think paying as you go is a great idea. And certainly, I get all the points and miles reward programs that are out there. But something I know I've practiced a lot in the last few years is I still use my credit card, but I literally go in multiple times a month and just pay it off, much as if I was using a debit card or just a checkbook. I'm getting the benefits of the credit card, but I'm never getting out of control and accumulating any debt. Not everybody can do that. I understand that, but whittling away at that debt with these high interest rates I think is vital.
All right, if I lined up a bunch of specialists here around the table, I'm sure that would be one of the hottest button debates. So thank you at least for entertaining the question here. Just lastly, while we have you here, as you're thinking about how you make decisions around funding your goals and how you achieve those, what are some of the steps that you can set up and make into routines as well?
Yeah, I think really linking your goal and then how you're going to accumulate money for that goal is such a big deal. Oftentimes there's a lot of debate about what's the right investment that I ought to be in. And I think that's sometimes out of syntax or out of sequence. And I really like to have my goal in mind before I even begin to think about how I'm going to invest for that. So I think at the top of the interview, you mentioned, accumulating money for car purchases are usually a big goal. Well, oftentimes, if that's going to be within 12 months, we probably then don't need to be thinking about the stock market or crypto or real estate. Those, I think, are investments that are better aligned and geared for longer term investments like my retirement or accumulating education funds for a child who's going to go to school 15 years from now. So I think really begin with the end in mind is a great place to start, is what am I trying to attack or accomplish? And then aligning my decisions, like investing, with those timelines.
Derek, thanks so much for taking the time here with us. Good to see you.
Thanks, Brad.
When you're spring cleaning your finances, you may also want to look around your home. Angie's 2024 State of Home Spending Report reveals that 61% of homeowners are concerned about affording maintenance or repairs in 2025. Here to discuss 3 things all homeowners should check now in order to avoid a costly repair down the line. We've got Angie Hicks, co-founder of Angie. Great to have you back here on the show with us. So your 3 things are HVAC maintenance, roof and gutter maintenance, and siding and founding maintenance. So let's start with HVAC. What should people be doing there, and what are the potential costs down the line?
Sure. Always starting with your heating and air conditioning tune-up is the most important thing you're going to do. That is the biggest user of energy inside of your home. So having your air conditioner tuned up in the spring, your furnace tuned up in the fall is an important thing to budget for. It's usually $150 to $200 to have done, and you're going to have someone come out, look at your system, make sure it's in good working order, and help to make sure that you're not going to have a problem once we get in the heat of the summer. Now, this tune-up does not replace your every month or every couple of months changing of a furnace filter. You should be doing that regularly yourself, but having that professional out twice a year could save you from having a major bill, or alternatively having to replace your unit, which could be $10,000.
All right, next up, let's talk about this roof and gutter maintenance. What do we need to know there?
Roof and gutter, those are protecting your house. They're keeping water out of your house. So the spring of the year, great time to walk around, make sure you don't have any loose shingles, make sure your gutters and downspouts have been cleaned. It's a couple $100s to have your gutters cleaned. I encourage you to hire a professional, because that is all too often where we hear about people having accidents around the house because they fall off a ladder. And then just making sure, even when you're doing your landscaping this summer or doing your mulch, make sure those gutters and downspouts are pushing water away from your house, because you do not want water pooling around your foundation, potentially heading towards your basement.
Okay, and so you mentioned the foundation, and this is another of the top 3 things that homeowners should be keeping close eye on and perhaps prioritizing: the siding and foundation maintenance. What are some of the top tips and advice?
Yeah, you want to walk around your house and just check for any damage in the siding, or if you have a brick exterior in the brick, or any damaged wood if you have a wood house. And you want to address that right away, because you don't want to let that grow into a bigger problem. The same with your foundation. Look at the foundation at the base of your house. Make sure you don't have any cracks. If you do have cracks, get a professional out there to take care of that. A crack caught early could be a few $100s, but serious structural foundation problems could be tens of thousands of dollars.
Angie, good to see you once again. Thanks so much for the
Thank you.
helpful
Thanks for
advice
having
this
me.
spring. Definitely. Coming up, the Trump administration has indicated some interest in taking Fannie Mae and Freddie Mac private. We discuss the potential implications after the break. A programming note on today's episode of Warrior Money. Patrick and Dan, they speak to Army Ranger veteran turned financial advisor Marcus Hull to discuss his journey from the 75th Ranger Regiment to guiding veterans on building wealth.
I think the biggest advice that I would give, Patrick, would be to tell those warriors who are separating from service that do not discount the leadership knowledge that you've learned in your time in service. That is a huge benefit. It's very hard to articulate that. You have to do something that you are probably not used to, is you have to become your best advocate, right? You have to figure out how to put it into a position where the civilian world can understand that you have leadership that you've gained, even if it's only in a short 4-year enlistment like I did. I was able to really learn a lot and apply that to my day-to-day life and still use a lot of those principles.
You can watch new episodes of Warrior Money every Friday at 12:30 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. The stocks of Freddie Mac and Fannie Mae got a boost this week amid new signs that the Trump administration could loosen the government's grip on the mortgage giants. U.S. Treasury Secretary Scott Bessent appeared to suggest on a podcast that the government's stakes in Fannie and Freddie could land in a new U.S. sovereign wealth fund. And previously, the Wall Street Journal has reported that Trump has considered the privatization of Fannie and Freddie. So what could that look like? Here with more, we've got senior housing reporter Claire Boston. Claire, let's just take a step or two back here first. What are Freddie Mac and Fannie Mae for those who want to get brought up to speed here.
Right. This is a very complicated situation. So Fannie and Freddie are what we call government-sponsored enterprises. They were created by Congress to help support the mortgage market. They don't make mortgages, but they buy up mortgages from lenders like banks. And the idea there is that then banks have more capital, they can turn around, lend more mortgages. It's one of those things that is very quietly sort of powering the U.S. housing finance engine here.
Where are these entities at in their phases of evolution and how they've become what they are today?
Right, so we have to kind of go back to the 2008 financial crisis. As you may recall, Fannie and Freddie, they bought up a bunch of risky mortgages and they were all going bad and they nearly failed. The government was worried that if Fannie and Freddie collapsed, they would take the whole mortgage finance system down with them. And so what the government did is that they took them under what is called a conservatorship. And so since 2008, the government has essentially controlled Fannie Mae and Freddie Mac. This whole thing was supposed to be temporary, but just given how important they are to the mortgage market, they have not been released from this conservatorship because in part of concerns about what would happen to the mortgage market.
And so with that in mind, why does this matter for everyday people at the end of the day?
Right. So, when I was talking about those concerns for the mortgage market, one of the big fears is that if Fannie and Freddie are released from government control, they will be seen as riskier credits, and that could ultimately make mortgage rates go higher. Brad, we talk a lot about mortgage rates. They are pretty high right now at about 6.7%. And there's a lot of fear politically that if Fannie and Freddie are released and something goes wrong, investors get worried, mortgage rates would go higher, and that would hurt average Americans. So it's a kind of a pickle for the Trump administration to be in. There are various ways they could try to release these GSEs, as we call them. But they're very concerned. They don't want to create a perception that they have hurt the mortgage market here, since so many people rely on their homes for their wealth.
And so from what we're hearing from the administration, what are they saying about mortgage rates as well?
Right, so Secretary Bessent has specifically said, I am watching mortgage rates. Any sort of release of these GSEs are going to depend on mortgage rates. Folks I talk to, it's hard to put a number on it, but they say typically mortgage rates could go up by anywhere from like 20 basis points to 1.5 points, depending on how these GSEs are released. So it's something that the administration is aware of and watching.
Claire, excellent breakdown. We'll continue to monitor any developments in this story as well.
Definitely.
Let's do a final check of the markets as we're taking a look at the major averages. Some slippage to end the week. The NASDAQ is down more than 2%, S&P 500 in the red by 1.5%, and also the Dow Jones Industrial Average, you're seeing that lower by about 1.25% as we head into the lunchtime hour here on the East Coast. If you're on the West Coast, then grab a bagel and just get kicking out there. I imagine that they've probably been up for a while too. As we're taking a look at these major averages, of course, this comes on the day of PCE, coming in a smidge hotter than expected. We'll continue to see how the markets digest that in the remainder of today's trading session. But that's it for us here on Wealth. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close.